As Vern said in the first part of the presentation, his role was really as the setup person to talk about how the corporation should be structured, what considerations should be brought to bear in setting up the share structure, given that Harry Henderson in particular has a family, Jane Blue doesn't, and Graham Smith is a non-resident. My task this afternoon is to talk about, now that we've got the corporation set up, how can these individuals extract funds from the corporation on the least tax cost basis. In discussing how we get funds out of the corporation, there's really a myriad of tax issues that come up and that you'll be potentially consulted on, and I'm just going to summarize them at the beginning and then I'll go through them one at a time. First and foremost, of course, is remuneration of the owner-managers and the other shareholders. And by owner-manager, I think you're all pretty much familiar with that term, but I use that essentially to talk about the controlling shareholder or controlling shareholders in the spirit in which Vern described them earlier. We also want to take a look at something called shareholder benefits and appropriations. You were cautioned by Vern earlier that that's not a good way to try to take money out of the corporation. By the time I'm finished discussing it, hopefully I'll scare you enough that you know it's an absolutely abysmal way to try to take money out of the corporation because there's a significant tax cost involved. Thirdly, we'll take a look at shareholder loans and advances in the sense not of lending money into the corporation. That's a fairly straightforward proposition, but in the sense of taking money out of the corporation and what some of the tax traps are that you have to be aware of. Then we'll take a look at dividends. Vern's touched on that briefly, but I'll look at some issues that you should be aware of in advising the owner-manager on the proper remuneration mix, where that includes dividends. Then we'll move on to some fun stuff, protection of corporate assets from creditors, or predators as they're sometimes called. And finally, we'll take a look at some of the tax considerations involved in the purchase and sale of a business, all of which I hope to accomplish by 5 o'clock. I wouldn't dare keep anybody past the scheduled time. So although I invite questions as we go along, if you get to the point where you have a question but we just run out of time, I will stay after if anybody wants to ask me questions on an individual basis. First of all, in looking at remuneration of owner-managers, as I said, it's really looking at the appropriate mix in any particular situation. There are basically 3 options. One is salary. You can include bonus in salary because they're essentially treated the same. Second is dividend income, and the third is deferred income. Now, I said they were options. They aren't necessarily all options that you should pursue, but those are the types of things that you can consider in the back of your mind when either you and the client's accountant are approached by the owner-manager of a private corporation. In terms of how they're taxed, Vern's pretty much set the groundwork for me. In fact, I told him at the break that he's just given my presentation, but I'll try to give a little bit more detail as to the types of things that we would look at. In terms of determining the mix, first and foremost is the question that was raised from the back: is it really vital to bonus down to the $200,000 amount? I agree with Vern, except in particularly exceptional circumstances, you should bonus down to the $200,000 amount in the corporation. Then the issue becomes, well, if you're going to do that, how do you do that so that the corporation gets a deduction and so that the individual can take money out at least tax cost? In terms of bonusing down, probably the word says it all. We're not talking about dividends here, because as I think most of you realize, the corporation doesn't get any deduction when it pays a dividend. A dividend is paid out of after-tax income, as opposed to either salary or bonus, which is paid out of before-tax income. The bottom line being, if you're trying to get down to a $200,000 or less amount of active business income in a particular taxation year, it has to be by way of either salary or bonus. As far as the individual owner-manager is concerned, what he or she will be interested in is receiving enough salary income to maximize his or her RRSP contributions, but not receiving such a high amount of salary or income as to pay tax on all of the money received out of the corporation at the maximum marginal rate of 53%. To reiterate that point, as I think you realize from Vern's discussion, salary or bonus is taxable at the maximum amount. The rates are graduated, but it doesn't take too long to get to the maximum marginal rate of 53% combined federal provincial rate. In fact, anything over about 50,000, 55,000 usually gets you into that rate. On the other hand, in order to maximize RRSP contributions, which for 1994 is the dollar amount is going to be $13,500, the technical determination, which I'll get to a little later, is the lesser of 18% of an individual's earned income for the previous year. So in this case it would be 18% of their 1993 earned income, essentially their salary, and 13,500. You have to get up around 87,500 in salary. So there's a little bit of a tug of war there. Yes, getting the maximum RRSP contribution eligibility will require getting enough salary and or bonus that you'll end up in the maximum marginal rate, but you'll also get the deduction for the RRSP contribution, which is Vern's tables that he showed earlier indicate is well worth the extra added income. Now, in terms of salary, for an owner-manager of a private Canadian corporation, there basically is no reasonableness test. For another shareholder, there basically is a reasonableness test. Now, that's all within the parameters of revenue of the corporation and profit of the corporation. I mean, Revenue Canada will object if a corporation earns $100,000 in profit and has paid out its owner-manager $500,000 salary. But as long as there's some correlation that the owner-manager's salary or bonus isn't significantly in excess of the corporation's after-tax profits, or sorry, before-tax profits, then I think that there's not any test applied by Revenue Canada, and virtually any amount can be paid to an owner-manager. So that would apply in the case of Harry Henderson and Jane Blue. They're essentially the owner-managers of this corporation in our example. On the other hand, Harry Henderson's spouse, with the Flintstones coming out, I remember her name, I think it's Wilma, and children who are in the family trust are very much subject to a reasonableness test. They're not in a position to control the corporation, and Revenue Canada is going to take a look at the amount that they're paid, and it better be commensurate with the services that they provide. The test that Revenue will apply is they will look at the services that are actually provided, compare what is received by the shareholder to what would be received by an independent third party, and if it's considered out of line with what the corporation would have to pay an independent third party, will deny the deduction to the corporation of the amount in excess of what would be a reasonable amount. In terms of bonuses, the issue does have reasonableness concerns, even for an owner-manager, because really bonusing is viewed by Revenue Canada as a means of allowing the corporation to reduce its rate on active business income, which is in excess of $200,000. Revenue Canada may be a lot of things, but in this day and age, they're not stupid. And they know that while salary may be a reflection of the blood, sweat, and tears that owner-managers devote to their business, that bonuses are really just a device to try to reduce corporate income so that the corporation will pay tax only at the 23% rate that Vern alluded to earlier, and not have to pay tax at the 44% rate on any active business income in excess of $200,000. Consequently, in advising your clients, you better tell them that any amount of bonus that's paid has to be reasonable in the circumstances. The other point on bonuses, which I describe in my paper, is, as I'm sure most of you know, there's a practice of accruing bonuses just before the end of a taxation year. For those of you who haven't been through it, the purpose is to allow the corporation to get a deduction in the current tax year. Let's use 1994 as an example. And if we had a year end of June 30th, 1994, the practice would be for the corporation to declare a bonus to the owner-manager on June 29th, 1994, so that the corporation, in computing its income tax liability for its 1994 fiscal year, can take a deduction of that amount. And the only requirement in ensuring that it gets that deduction is that the amount actually be paid within 180 days of the end of the fiscal year. So in that case, it would have to be paid by 180 days following June 30th, 94, which is essentially December 31st. If the amount is not paid within that 180-day period, So in other words, pay it by no later than the 179th day following the end of the fiscal year, then the corporation can't take the deduction for the current year. In other words, in my example, it wouldn't get a deduction for the year ended June 30th, 1994. It would instead only get a deduction in its taxation year in which the amount was actually paid. So if that amount was actually paid in March of 1995 to Harry Henderson or to Jane Blue, then the corporation wouldn't have the deduction put off by a year. It would be put back by a year. I guess the final point that I wanted to talk about was deferred income, because there was a practice up until a few years ago of remunerating owner-managers and other shareholders up to an amount that would allow them to maximize their RRSP deductions, and any amount above that would be structured in a manner that the payment was deferred to them so that the tax liability was deferred to them. It was a pretty clear system. It was employees, which owner-managers are in that capacity, are taxed on a receipts basis. If they didn't receive the funds in the current tax year, say 1994, they wouldn't be taxed in the current tax year. They'd still be in a position in a future year to receive the money and be subject to tax in a future year. But as the tax saying goes, a tax dollar deferred is essentially a tax dollar saved. Those are in the days of mounting inflation, when anything that you could defer to a future year is virtually as good as a tax saving. As I said, Revenue Canada may be a lot of things, but in this day and age they're certainly not stupid. They caught on to the fact that deferred compensation was a widespread practice and completely revised the system for both tax-assisted retirement savings and deferred compensation in the late 1980s. In the situation that I just described, the concept of a salary deferral arrangement was introduced into the Act, effective in the mid-80s, which would say that if, in the case of our example, Harry Henderson received an amount of salary this year, but didn't receive until, say, 2 years from now, an amount that he, he would have otherwise received this year that was attributable to services rendered by him this year, and the fact that he deferred, or that the receipt of the funds was deferred, was clearly tax motivated, then he would be taxed on that in the current year on the basis of the principle of constructive receipt. Constructive receipt's a principle that's been with us for a fairly long period of time. It's essentially where I would have otherwise received something in income this year, but I managed to defer it, or I managed to have it received by somebody other than myself. As far as the income tax authorities are concerned, I should have received that amount, and I should have received that amount currently, so therefore I'm going to be taxed on that amount currently. Well, then we look around at other forms of deferred income, and what are the possibilities? Well, I guess one of the leading possibilities is a pension plan. A pension plan, as most of you know, is something where both the employer and in certain cases the employee make tax-deductible contributions in a current year and will receive amounts out of the plan upon retirement in the form of an annuity. The problem with pension plans until the late 1980s, and I think Bill Johnson's here, he's responsible for revising the system, was that any amount that was received by an owner-manager who was a significant shareholder, that is a 10% or more shareholder in a private corporation, couldn't be any richer than the amounts that were received by all other employees out of the pension plan. In other words, these so-called top hat pension plans that were available for senior executives in corporations, which allowed them to go over and above the amount of pension plan receipts that could come out of the statutory scheme in the Act for pension plans, simply wasn't available to a shareholder who was a significant shareholder. And since the threshold for that is only 10%, it's pretty easy to see that owner-managers couldn't participate in those types of plans. Well, the first change was that as part of the comprehensive reform of tax-assisted retirement savings in the late 80s, individual pension plans for owner-managers are now possible. In other words, this restriction, the 10% rule for significant shareholders, has effectively been removed, so that it is possible for owner-managers to now participate in pension plans that are only for them and that are richer than the pension plans that are available for the other employees in the corporation. It's a form of deferred income in that they'll see a richer pension plan down the road, and it may be an incentive to the owner-manager to take less out of the corporation presently. And remember, the name of the game is for the owner-manager to take funds out of the corporation at the least tax cost. And they'd be taking those funds out at a time when their marginal rates would be significantly less than they are now. The second significant change, and another area which you should consider in advising owner-managers, is the role of RRSPs. We've touched on that briefly, but essentially any owner-manager who isn't maximizing his or her RRSP contributions is foolish. Because as we all know, by the time most of us retire, there won't be a Canada pension plan or an old age pension plan, and that means that it's essentially up to us. So that owner-managers, in addition to maximizing their pension funding, should also maximize their RRSP contributions. And granted, for those of you who are familiar with the pension plan system as it relates to tax-assisted retirement savings, the amount that can be contributed to an RRSP is significantly reduced where an individual is also a member of a pension plan, but it's certainly better to contribute what's available, even in a reduced fashion, than it is to contribute nothing. And for those owner-managers, just like for those practitioners who don't have pension plans, really the RRSP is the leading form of retirement savings, as Arthur Skase told all of us who took Bar Ed Tax with Arthur Skase. That was lecture number 1. Finally, you could consider the issue of deferred profit-sharing plans, which, as most of you may realize, is a mechanism whereby an employer can make tax-deductible contributions to a plan which is a trusteed plan. It's managed either by a corporate trustee or by 3 individuals, and that the employee will not be taxed on any of these funds until he or she actually receives the funds. Now, in tax planning for shareholders of private corporations, there's good news and bad news when it comes to DPSPs, deferred profit sharing plans. The good news is employees who are not shareholders or who hold less than 10% of the shares of the corporation can participate in a DPSP. However, employees who are also shareholders who own 10% or more of the shares of a private corporation cannot participate in a DPSP, nor can members of their families. Bottom line, owner-managers can't utilize deferred profit-sharing plans. Other shareholders can, provided they're not related to the owner-managers. At this point, I'm going to move on to shareholder benefits and appropriations, unless anybody has any questions on the issue of remuneration. Yes, Jim? I'm talking about voting shares. Okay. If somebody held preference shares, then that wouldn't be an issue, provided they were non-voting. If they were voting, then they'd have to look at the amount in terms of the overall mix. If they held 10% or more, they'd be considered significant shareholders. In terms of how you should or shouldn't take out funds of the corporation, as I said at the beginning, a shareholder benefit, which is also called a shareholder appropriation, is probably the most abysmal way of taking funds out of the corporation. Unfortunately, sometimes owner-managers and other shareholders use the funds on hand in private corporations as if they were an extension of their own bank account. As the current expression goes, no. Subsection 15(1) of the Act was specifically put in to tax, by including in income, any amount which is essentially a distribution to a shareholder from the accumulated wealth of the corporation, which isn't in the form of a taxable dividend or a deemed dividend. In other words, this provision is the catch-all. As Vern explained earlier, when dividends are declared, there's a tax system, gross up and credit system, which essentially taxes dividends at 36%. When certain reorganizations of the shares of the corporation take place, such as a redemption of preference shares, or a purchase for cancellation of common shares, or a winding up or liquidation of the corporation, up to the paid up capital comes back tax-free, but any amount above that is a deemed dividend, which is treated for tax as an ordinary taxable dividend. Any other amount which comes out of the company to the individual has to be considered for tax purposes either a subsection 15.1 benefit or a subsection 15.2 loan or advance. And I'll get to the loans and advances in a minute. But if it's simply a benefit, or the shareholder appropriates property of the corporation, or an amount is paid to the shareholder by the corporation and it's not part of a bona fide business transaction, then that amount will be included in the shareholder's income. And since it's ordinary income, it will be taxed at the maximum marginal rate. And we're assuming for these purposes that the owner-manager is in the maximum marginal rate, so essentially the tax on such a benefit will be 53%. In determining the value of the benefit, it's really done on a fair market value basis. If it's cash, it's clear what the owner-manager has received. If it's property, then it has to be valued. And quite frankly, that's not a situation where the lawyer will be asked to determine the value. The accountant will be asked to determine the value. But you still should be aware of it for the reason that I mentioned at the beginning. Too many owner-managers treat the bank accounts of their corporations as their own personal corporations. Their own personal bank accounts. Another issue to look at in terms of shareholder benefits is the shareholder benefit imputed interest rule. That applies to a low interest loan or an interest-free loan that's received by a shareholder. When a shareholder receives an advance or becomes indebted to a corporation, there's really two things that a shareholder has to watch out for. Number one is the fact that a prescribed rate of interest set by the government every 3 months will be applied to the principal amount of the loan and will be added to the individual's income. And unless the amount of interest actually paid by the shareholder in the year to the corporation on that advance is at least equal to the prescribed rate, then there'll be a taxable benefit to the shareholder. The other, and more significant from a tax perspective, consequence to a shareholder of receiving an advance or becoming indebted to the corporation is subsection 15.2, and I describe that on page 12 of the paper. It's probably the area of shareholder benefits that, as I say, requires the most care and attention. Subsection 15.2 is really a preventative section. It's to prevent individuals from taking loans from corporations in which they hold shares unless a number of criteria are satisfied or the loan fits into one of the exceptions which is described in subsection 15.2. The idea is that it's to prevent a tax-free distribution of corporation funds in the guise of a loan to shareholders. The rules, as I say, are that the loan has to be repaid within one taxation year, and that's of the corporation, of the year in which it was taken out. So again, if we go back to my example of a corporate year end which ends June 30th, 1994, if Harry Henderson took out a loan from the corporation today, he would be required to repay it by the end of the taxation year of the corporation following the year in which the loan came out. So the end of the next taxation year of the corporation would be June 30th, 1995. Under subsection 15.2, if Henderson hasn't repaid that loan in full by June 30th, 1995, then the entire amount of the loan will be added to his income, but it will be added to his income for 1994. So it's a rather punitive provision. The other rule is that it must be a loan in which there is a bona fide arrangement for repayment within a reasonable period of time. So in other words, to continue my example, if Henderson took out this loan but turned it into kind of a revolving loan account where he borrowed it and repaid it in July, borrowed the same amount or a different amount in August and repaid it in November, then that wouldn't satisfy the requirements in subsection 15.2. It would be considered a loan that was a part of a series of loans and repayments, and the likely result would be that the amount of the loan would be included in his income. And I guess the final important point is that there are a number of exceptions to the rule, so that there are certain purposes for which shareholders can receive loans from their corporations and not be caught by this provision. And you see it happen in a number of circumstances. One of the exceptions, which is not a very frequent one, is where the corporation has as part of its business the lending of money. So any employee of a bank any shareholder of a bank or of an insurance company or any other financial institution which has the lending of funds as part of its business activity doesn't have to worry about subsection 15.2. But of course, those exceptions aren't that frequent. Second, more frequent exemption is the acquisition of a dwelling. If the loan is made to the shareholder or to his or her spouse for the purpose of buying a dwelling in which they will inhabit, then it's not subject to the rule in subsection 15.2. It's called the shareholder housing loan exemption. The third is the treasury share exemption, and that is a loan to a shareholder to acquire treasury shares of the lending corporation, the corporation in which he or she owns shares, or a related corporation. A fourth available exemption is the automobile exemption, and that is where the shareholder is also an employee of the corporation and acquires funds to buy a car to enable him or her to perform their duties of employment. Other than that, if a shareholder takes out funds from his or her corporation in the form of a loan and doesn't repay it by the end of the first taxation year of the corporation following the year of loan and doesn't satisfy the other rules that I described earlier, then Revenue Canada will add the principal amount of loan to his or her income for the year of the loan. I go into my paper in an example of a situation where Revenue Canada has announced a more aggressive assessing practice. It's not a particularly recent announcement. It's probably been around for about a year and a half. It reflects the fact that Revenue Canada has twigged to the fact that owner-managers and other shareholders are using their corporations as a form of banker. And basically what happens is, or was happening in practice to a certain extent, is a lot of these advances were being made without formal journal entries being made and formal documentation being signed, loan documentation, and appropriate resolutions being signed. And at the end of the year, there would be a cleanup to make the advance either look like a proper advance or to make it look like a dividend. And then the client or the accountant would come along to the lawyer and say, oh, by the way, just before the end of the year, there was a formal advance made of $100,000. It may have come out to me in dribs or drabs prior to that time, but just document it that way. Or the alternative would be just document it as a dividend. A caution to all of you, if you get involved in a situation like that, is to get the client in particular, and also the accountant, to satisfy you that what they say has happened has actually happened. You don't want to be in a position of rewriting history, because if there's a problem, if Revenue Canada seeks to knock it down and the client starts to scream, you don't want to be implicated with the client. You want to make sure that you haven't participated in rewriting the facts as they are presented. You want to make sure that all you're doing is recording the facts as they're being presented. The bottom line is Revenue Canada is hot on the trail of people who are using their corporations as a banker, and they don't particularly like people who take benefits from corporations, appropriate funds from corporations, or use their corporation as a bank. So be very careful when you're advising clients that they shouldn't be able to inject and take out funds at their leisure. They have to be very careful to be aware of what they're doing, and it's really up to you to educate them as to the provisions of 15.1 and 15.2. Next topic is the tax treatment of dividends, and Vern has done a basic introduction on that, so I can go through it fairly quickly. I guess the key point is that in tax reform in 1971, the whole system was turned on its ear, so that the result is, as Vern had described earlier, any amount up to paid-up capital can be taken out tax-free. Essentially, any amount above that is a dividend. And that comes into play particularly when there's a reorganization of the share structure of the company. Looking at the issue of taxable dividends, as Vern's already described, the system is based on the integration principle, that the corporation's already been taxed. So as a result, the shareholder shouldn't be double taxed. The shareholder has to gross up the amount of the dividend that he or she receives excuse me, by 25%, but then gets a dividend tax credit of an essentially equal amount. So the bottom line is that the total tax paid by the corporation on earning the corporate income and the shareholder on receiving the distribution should be equal to the amount that would have been paid in tax by the individual had he or she been in a sole proprietorship. As Vern also said, unfortunately, because of actual rates that are in practice today, the integration system doesn't work perfectly. However, the key is that dividend income is still taxed at an amount significantly less than salary income and significantly less than bonus income. It's also taxed at an amount somewhat less than capital gains. As I said, probably the key point is the deemed dividend point, and that is whenever there's a reorganization which involves a change in the capital of the corporation, as well as asking yourself what the change is, if any, in paid up capital, you should also ask yourself whether there's a deemed dividend. And by reorganization, I mean, as I said earlier, redemption of shares, purchase or cancellation of shares, winding up, liquidation of the corporation. The rules are fairly straightforward. Any amount up to the paid up capital comes out tax-free. Any amount above that is a deemed dividend. And even though there's a disposition of the shares that the shareholder owned, essentially there's no capital gain because the shareholder's already being taxed on the difference between the proceeds and the paid up capital as a deemed dividend. I guess the other point to be aware of in dividends, I covered in my paper and I haven't covered yet, is even though individuals are subject to tax on dividends, what about corporations? What if, as in the case at the present circumstances, the operating corporation, Peterson Enterprises, will be owned by a number of holding corporations? Essentially, intercorporate dividends, provided they're paid by a taxable Canadian corporation, and that's a corporation that's resident in Canada and not exempt from tax, to another corporation that's resident in Canada, go tax-free, pursuant to the provisions of Section 112 of the Act. Now that's provided that the recipient corporation, the holding corporation, is connected with the operating corporation. And that's where the Part 4 tax that Vern alluded to earlier comes into play. Two corporations are connected if either the recipient corporation controls the payor corporation. So in this case, OpCo would be controlled by HoldCo, because more than 10% of the shares of OpCo would be held by HoldCo. Just to refresh your memory, each of Jane Blue's corporation and Harry Henderson's corporation own 25% of the issued shares of PEL at a minimum, or if Graham Smith doesn't own any shares, each of them own 50%. So as long as those corporations are connected, either the top corporation receiving the dividend controls the bottom corporation, and by that we mean control in law, not control in fact, or the top corporation is connected with the bottom corporation, it owns more than 10% of its shares by votes and value, then there will be no Part 4 tax, and this intercorporate dividend will be tax-free. If it's a portfolio investment, so that the top corporation owns less than 10% of the shares of the payor corporation, then this Part 4 refundable tax will be payable. And the Part 4 tax, as Vern had earlier said, is 25%. One point you may wish to write down is that the February 22 federal budget proposed that the amount of Part 4 tax go up from 25% to 33.33%. The purpose for that is to discourage investment holding companies. This is an aside to the presentation, but I think it's useful information. A number of individuals now are convinced that an investment holding corporation is the way to go in holding their investments. The reason being that with the preferred rate of dividends, the preferred rate of tax on dividends as individuals, their tax rate is reduced. However, there's an even better tax rate on dividends for corporations, provided that they're connected. Obviously, there's no tax at all. Even if they're not connected, then the amount of tax that's payable by the investment holding corporation is only 25%. Compare that with the 36% that they would pay if they received the dividends individually. So if they can afford to park this dividend income in an investment holding corporation beyond the end of the tax year in which the dividends are received, then a tax deferral of about 11% has been achieved. Well, the government has twigged to that and has proposed increasing the Part 4 tax on these portfolio dividends up to 33.33%, so that essentially the rate is only a couple of points less than the rate of a tax on dividends received by individuals. Finally, And I don't want to go into this in any detail today. As Vern had earlier said, I think certain topics are beyond the first in this series of presentations. There are some notes in my paper on the preferred share rules. I'd suggest that you take a look at them at your leisure. Essentially, a few years ago, the government became concerned with the preferential tax treatment on dividends, and in particular that because preferred shares could be structured in their attributes to be virtually identical to the attributes of a debt instrument, that preferred share financing became much cheaper to individuals than did debt share financing. And so they imposed a couple of different taxes, being a Part 4.1 and Part 6.1 tax on taxable preferred shares. One rate is 40%, the other is 25%, and there are different reasons why you would come under either of those rates. And also for a short-term preferred share, which is a share that can be redeemed or retracted within 5 years of issue, there's an even higher tax of approximately 66 2/3% levied. The bottom line to all this is where you're involved in a financing or a restructuring of a corporation, be careful of the share attributes. If they are retractable and redeemable within 5 years, I think you owe a duty to your client to let him or her know that there are preferred share rules in the Act now, and that they'll have to be wary of them. The good news is if you're dealing with an owner-manager in a small corporation, there's a $500,000 exemption, so it's going to take an awful lot of those dividends before there's anything to worry about. That's pretty much it for extracting funds by an owner-manager by means of either salary, bonus, dividends, or deferred income. If there are no questions, I'm going to move on to the fun stuff, which is the protection of assets from creditors. As most of you fully realize, in the past few years with the recession that we've gone through, countless businesses have failed or teetered on the brink of failing, and it's not uncommon for a client to come into a tax practitioner or a corporate practitioner and seek to have the corporate or tax practitioner structure a mechanism whereby they can escape either personal insolvency or business insolvency, or if they are convinced that that's going to be the result, at least try to protect their assets from their creditors. I'm not here to moralize to you. I'll simply make the statement that you better be pretty careful when a client comes in and asks those types of questions to get enough information from them to satisfy yourself that they're not already insolvent or that their creditors are not already breathing down their necks. Because if that's the case, it's probably too late for anything to be done which will be effective. And you certainly don't want to be considered to be a party to either a fraudulent conveyance or a fraudulent preference. Since the focus of this conference is beyond detailed examination of the Bankruptcy Insolvency Act or the Assignments and Preferences Act or the Fraudulent Conveyances Act, I'm not going to go into the details of any of those, but you should be aware of their provisions and what are attackable transactions. As a tax practitioner, we usually engage in tax-motivated transactions to restructure corporations and their share structures. And we have a duty, first of all, to our clients to make them aware of the fact that in certain instances it's simply going to be too late for a transaction to be effective. In other instances, that they cannot engage in a fraudulent preference, fraudulent conveyance, or something that's attackable under the Bankruptcy and Insolvency Act, and we won't be a party to it. However, having said all that, there are some things that can be done at the outset of a business arrangement, and those are the kinds of clients that you are in a position to assist. Somebody who is setting up a business and wants to structure both the share structure of the business and the ownership of the assets of the business in a manner that it's less likely that the creditors can attack those assets. And first and foremost, as I said in the paper, is to limit personal liability on the part of the owner-manager. As most of us know, when an individual sets up a corporation to start a new business, they fall in love with the idea of limited liability, that they're only subject to liability up to the amount that they pay for their shares. They immediately fall out of love with the concept and with you when you tell them that chances are 99 out of 100 that their banker is going to ask them to personally guarantee any loans that the corporation obtains from the bank, including the line of credit. But where it's possible that the individual not personally guarantee obligations, such as lease obligations and loan obligations, then you should be advising them to resist that to the fullest extent of their ability. Because there's no point in an individual setting up a corporation if the limited liability protection is destroyed by them personally guaranteeing everything in sight. The second technique I've called multiple corporations for lack of a better description, and that's a situation where a corporation is organized to carry on an active business, but as part of that active business will own other assets of value, for example, real estate, or particular equipment that could easily be owned by a sister corporation. Down the road, if the corporation runs into trouble, if all of those assets are owned by the corporation, they're attackable by the creditors. And if an individual owner-manager comes to you at that time, it may well be too late. Even if transactions are structured to move assets around at that time, the provisions of the Bankruptcy and Insolvency Act or Assignments and Preferences Act or Fraudulent Conveyances Act may apply to allow those transactions to be undone. So a better approach is at the beginning to find out through asking a series of questions to your client what types of assets they envisage acquiring at the outset of the business and what types of assets they envisage acquiring as the business goes along, so that any assets that can be put in a sister corporation at the beginning are done so, and any assets that can be put in a sister corporation when they're acquired in the future can also be acquired by the sister corporation as opposed to the operating corporation. It's just basic common sense. Finally, and the most fun part of creditor proofing has also been alluded to by Vern, and that's the removing of the retained earnings of an operating corporation up into a holding corporation. It's very easy to understand that clients, when they come in, can think of hard assets, real estate, equipment, as being attackable by creditors, but very often you have to point out to your clients, well, what about your retained earnings that are sitting there? And after you've discussed that with them, they realize that the retained earnings are even easier to attach than are the hard assets. So as Vern had earlier alluded to, the magic is to have a holding company incorporated and to have the retained earnings of the operating company dividended up on a tax-free basis to the holding corporation. That's going to be subject to the solvency requirements in the Ontario Business Corporations Act or the Canada Business Corporations Act, but subject to that and assuming that dividend is going to be paid which does not render the company insolvent, then it goes up on a tax-free basis. But in this day and age particularly, those funds are probably required by the operating company for its day-to-day operations. The most commonly used technique, once again, is to lend the funds back down to the operating company by the holding company and have the holding company register a financing statement under the PPSA, also execute a GSA. Also have the operating company execute a GSA in favor of the holding company, and for those of you who are not familiar with that, general security agreement, so that the holding company will become a secured creditor in respect of that amount that it's relent back to the operating company. It's very unlikely that you'll stand first. If you want to continue to do business with your bank or any bank, they'll insist that they stand first, but at least it puts the owner-manager and his family, for example in Harry Henderson's case, who are the shareholders of the holding corporation, in a position that ranks ahead of all of the unsecured creditors of the operating company. So while it's not a total solution, at least it's of some comfort. Finally, I wanted to make some comments on the purchase and sale of a business. I think I can move past the initial point, which was asset sale versus share sale. Vern has already pointed out the respective preferences of the vendor and purchaser. The only thing that I'd add is that the final purchase price is usually a negotiated purchase price, which takes into account the different preferences, and there's a saw-off usually somewhere in the middle. However, given that the capital gains exemption, the enhanced exemption, still exists, and given that there's a number of loss companies around, it's fairly frequent in negotiations these days for a purchaser to switch sides in effect and agree to a share purchase, even though he or she would be giving up the stepped-up cost base on the assets, if there's an ability to access the tax losses of the corporation. In terms of accessing the tax losses of the corporation, there are a number of tests called the loss streaming rules that have to be satisfied. And if you can just move forward to Section D, which is on page 32, I'll deal with that now and then come back to the issue of pre-sale dividends and accessing the enhanced capital gains exemption. Whenever the control of a corporation is acquired by a purchaser, then there's a number of provisions in the Act which are activated. First of all, I should say what I mean by control. Well, in this case, it doesn't mean factual control, it means voting control or legal control. So where sufficient shares are acquired by a purchaser so that there is an acquisition of control by the purchaser, and provided it's not an exception to the rule, and the essential exception for you to be aware of is related persons. So in a situation where the purchaser is not related to the vendor, so that there is an acquisition of voting control and it's not by a related person, then the tax consequences are as follows. Number one, there's a deemed year-end of the purchased corporation. To take it back to the case study we're using, Peterson Enterprises Limited would have a deemed year-end because the control has been acquired by a group of persons. And these control provisions provide that where there is an acquisition of control by a person or a group of persons, then the rules that I'm discussing come into play. And the group doesn't have to be related. So there's a deemed year-end on the date of acquisition. That brings into play a series of other rules. The most important one is what's called the loss streaming rules in Section 111 of the Act. And that provides that net capital losses, essentially capital losses that the corporation was carrying in excess of any capital gains that it had made, fall off the table. They're simply not available following an acquisition of control. The second rule is that non-capital losses, as they're called for tax purposes, or business losses, become streamed. And that means that the only way that they can be used in the future is if the purchased corporation, in this case Peterson Enterprises Limited, continues to carry on the same business that it carried on before, and with a reasonable expectation of profit. So in other words, it can't be going down an endless hole. There has to be some kind of turnaround. And as I say towards the end of that paragraph of commentary, if that corporation carried on a business of selling or acquiring a particular property or services, then if the acquiring company carries on a similar business that involves the leasing or the sale of the same property or the same kind of services, then the losses, although they are streamed, are also available. So in other words, the loss corporation itself has to keep carrying on the business, and the income that it can be applied against is either income that's generated by that same loss corporation, if it's kept as a subsidiary corporation, or by the carrying on of the same or similar business by the acquisitor corporation, and that particularly applies when somebody acquires a corporation through a holding corporation and then merges the two corporations after. The other result of the acquisition of control is because there's been a deemed year-end, there's a shortening of the loss carry-forwards. As most of you know, non-capital losses, business losses, can be carried forward for 7 years. When there's a deemed year-end, then one of those 7 years falls off the table. So if you're towards the end of the 7-year period, it's significant. If you're at the beginning of the 7-year period, it may not be significant. I said that I would go back to the issues of accessing the enhanced capital gains exemption on a share sale and pre-sale dividends, and I'm going to try to cover them in the next 10 minutes or so. In terms of the enhanced capital gains exemption, and that starts at page 25 of the paper for those of you who are trying to follow it. As most of you know, on February 22nd, 94, the federal budget got rid of the $100,000 capital gains exemption. For those of you who followed it carefully, yes, there is an ability to use it this year in filing your tax return based on a notional disposition on February 22nd. So in other words, the gain that accrued up to February 22nd is still available for the $100,000 capital gains exemption, but only on this notional disposition basis. It's not available on an actual disposition on June 8th, 1994. That was the bad news in the budget. The good news in the budget was that the $500,000 capital gains exemption, the so-called enhanced capital gains exemption, wasn't eliminated, although it's pretty clear from the commentary in the budget that it's on the endangered species list. And I would think that this next year is the last go-around that we'll have with accessing the capital gains exemption. The $500,000 capital gains exemption is available for dispositions of what are called qualifying small business corporation shares. And tying that back into what we're discussing today, they have to be shares of a Canadian-controlled private corporation, which, as we've told you, is a corporation that's not controlled by non-residents. Okay, it can be up to a 50-50 situation. That is also a small business corporation, and that means at the time of disposition of the shares, more than 90% of the assets of the corporation are attributable to use in a active business carried on primarily, more than 50%, in Canada. At the same time, this 90% test applies only at the time of disposition. So what happens in practice is you get the financial statements from the accountant, and you ask the accountant if the company qualifies, because they're supposed to be able to crunch the numbers, and invariably you get the answer back either yeah or yeah, I think so. So it's really up to you to go through with the provisions of the Act beside you to determine whether in fact more than 90% of the assets could be attributed to an active business, either of the corporation itself or of a related corporation. And it's pretty easy where you have a current balance sheet, but when it's out of date, then you have to ask the accountant for an updated balance sheet. You look at the assets, you speak to the client, question the client as to how the assets are used, question the accountant, who usually has a better knowledge of the company, as to how the assets are used, and then you still put it on the accountant to write you an opinion as to whether, in their view, 90% of the assets are used in an active business. That's great, but that's only the first test. There are two other tests that have to be satisfied. The second test is throughout the 24 months prior to the disposition, more than 50% of the assets of the corporation whose shares your client intends to sell have to be attributable to use in an active business corporation carrying on, an active business carried on primarily in Canada. Bottom line there is, it's okay to get a corporation on side at the time by purifying the corporation, moving out redundant assets so that less than 10% of them are not used in an active business. But you can't rewrite history. You're stuck with the history. And again, you have to get sufficient information from the client and the accountant, and careful practice would dictate an opinion from the accountant as to whether throughout that period more than 50% of the assets of the corporation were so used. And the third test is called the 2-year holding period test, and that is throughout the 24 months preceding the disposition, the shares that your client intends to sell can't have been held by anybody other than him or her or a person related to him or her. That's all well and good, but what happens when, in the period of time when a federal budget is announced? Not a lot of people have transactions already underway whereby they'll sell their shares to a purchaser, and that's where the concept of crystallization came into play. Crystallization is essentially just triggering the capital gain in a manner that your client can access the capital gains exemption, and it's usually done on an internal basis. In my paper, I have a description of how an operating company crystallization would work. Think of that essentially as an estate freeze transaction without the freeze and adding a Section 85 election to that. And for those of you who don't do tax and are very annoyed at me for throwing around that jargon. I apologize. What I mean by that is an exchange of the shares that your client owns in his or her corporation for shares of another class of his or her corporation of equivalent value on a basis such that there's, for commercial purposes, an exchange of value for value, and for tax purposes, there's an exchange on the basis that a $500,000 capital gain can be elected by the accountant in preparing and filing a capital gains, a subsection 85(1) election, and the owner-manager can then claim in his or her tax return for the year an offsetting capital gains exemption. The other method of crystallization is what's called a holding company crystallization, and that is where the shares of the operating company are exchanged by the owner-manager for shares of a holding corporation of equivalent value. The bottom line there is that a subsection 85(1) election can also be made to trigger a $500,000 capital gain, and an offsetting capital gains exemption can be claimed by the owner-manager in his or her tax return for the year. The bottom line is it provides a mechanism for crystallizing the capital gains exemption and stepping up the cost base of the shares from the adjusted cost base amount, which Vern described earlier, which is the amount that the client paid for the shares, to an amount equal to that plus $500,000. That's all based on the assumption that there's been a $500,000 accrued gain in the value of the corporation that's attributable to his or her shares. Finally, the other point that you should be aware of in the purchase and sale area is very often a vendor is interested in reducing the amount of capital gain that he or she will be subject to on a share sale, and that's on the assumption that they haven't crystallized the capital gains exemption prior to that, or even if they have, that there's a capital gain greater than the amount crystallized. And the purchaser is also interested in reducing the amount that he or she has to pay out of pocket. So usually the vendor will come to you and ask you what kind of pre-sale tax planning can be done to minimize his or her tax liability, and the purchaser will also go to his or her counsel to review whatever tax plan the purchaser's lawyer comes up with. There's essentially three different methods, two of which I haven't gone into in the paper because they're less technical, and we may get into that if we do a formal session on purchase and sale of a business later on, just so you have them for sake of completeness. One is the payment of a retiring allowance to the owner-manager if he or she will actually be leaving the business, and that's an amount that can be paid upon retirement in recognition of long service. It's a taxable amount, but can be rolled into the owner-manager's RRSP on a tax-free basis within certain limits. Basically, it's $2,000 per year of service after 1989, and either $2,000 or $3,500 per year of service for years before '89, depending upon whether the owner-manager employee had a vested pension plan or DPSP. And if anybody has any questions on that, I'll be glad to answer that after the session. The second method is a consulting agreement, which is usually an either-or. You don't usually get a retiring allowance and a consulting agreement, although I've seen them in combination. Then it's usually up to the owner-manager to show Revenue Canada that yes, they have retired as an employee, but yes, they are also providing consulting services to the corporation. And that's, again, to quote Vern's comment earlier, you have to leave a pretty careful paper trail on that. You'd need a consulting agreement. But again, that's a way of removing value from the corporation, because the corporation has obligations for either the payment of a retiring allowance or the payment of a consulting fee to the owner-manager. The one that I've discussed in the paper is a pre-sale dividend. And where the owner-manager owns the shares of an operating company directly, then the payment of a pre-sale dividend is like any other dividend. It's subject to tax at 36%. It represents a small marginal savings from the tax rate on a capital gain, which is essentially about 38.5% to 39% for somebody in a maximum marginal rate. A lot of people can't be bothered with it, but for people who can see that saving 2 or 3 points of tax is worthwhile, then it's an option. Where it's more frequently used is where the vendor is a corporation. In other words, the owner-manager held his or her shares in the operating company through a holding corporation. So what he or she is selling to the purchaser is the shares of a holding corporation. In that case, what happens is that the pre-sale dividend going up from the operating company to the holding company could be tax-free. It's an intercorporate dividend, so under Part 1 tax, it's tax-free pursuant to Section 112. Under Part 4 tax, since the holding company will presume owns more than 10% of the shares of the operating company, and usually owns 100%, it's tax-free under Part 4. Well, a vendor would think that they're home and cooled out. The only problem is that Revenue Canada has twigged to the fact a number of years ago that vendors are reducing their capital gains by this amount and converting them into tax-free intercorporate dividends. And not only is Revenue twigged to the amount, but Revenue doesn't like the amount. It doesn't like the concept because essentially capital gains are taxable at 39%, intercorporate dividends aren't taxed. So what Revenue Canada has imported into the Act in subsection 55(2) is the concept of safe income. Essentially, Revenue Canada will use section 55(2) to recharacterize that intercorporate dividend that's paid on a pre-sale basis from the operating company to the vendor's holding corporation. Every dollar of that dividend can be recharacterized as capital gains, so it will be fully taxable to the vendor's holding corporation unless it is the amount that's paid is attributable to the safe income in respect to those shares. And I could be here until 5 o'clock tomorrow morning describing safe income, but to try to simplify it, it's the post-1971 after-tax income of the operating corporation that's attributable to those shares. So if the owner-manager's holding corporation owns 100% of the shares of the operating corporation, then it's essentially all of the after-tax retained earnings, for simplification purposes, of the owner-operated corporation. If the dividend is restricted to that amount, then it can be paid up tax-free. If it's at $1 in excess of that amount, then it's going to be recharacterized as a capital gain. Is there a method of planning around it? Yes, there is a provision to allow you to split the dividend so that part of the dividend is a so-called safe income dividend and the rest is a taxable income dividend. Those are pretty much my comments on how you get money out of the corporation. All I can say is that you're going to be faced with these issues on a recurring basis because the setup of the corporation as described by Vern is only the first stage. As he said, people set up corporations for the purpose of earning money. They want to get the money into their own hands at least tax cost. And I hope that these comments have been helpful in enabling you to advise your clients as to how to get the money out at minimum tax cost. Thank you. I was also asked to mention, would you please fill out your evaluation forms? And Paul has told me that as an extra added attraction, they're only accepting the favorable ones today. Thanks very much.